Okay, good morning. So we are back and I have another exciting pick today. So we're going to look at Algonquin Power and Utilities Corp, or AQN, on both the TSE and the US stock exchanges. So here I'll be looking solely at the US listed version of the stock. So this is a utility. I do enjoy utilities. One of the big benefits about utilities in my mind is that they provide nice, generally very stable earning. We can begin to see from this picture here that the general sort of level of earnings is trending upwards. This white line represents the dividends. The orange line represents a 15 or 17 times price to earnings ratio. And we can see that that general operating earnings is increasing over time, which is what I like to see. I like to see a company that grows. Now, as well as that, it's also important that I want to be able to get into the company at a reasonable valuation, and there's lots of different ways of determining the valuation. I want to make sure that the company's a good company, that it's solid, that it's financially sustainable, that it's going to be there for the long haul. So there's a number of different ways that I can check all of this. But first of all, I want to just have a quick look at the perspective on fast graphs. This is one of my favorite tools for quickly assessing where a stock is at in terms of valuation and what those likely future returns are going to be. So we have here the historical chart. As I said, we can see that overall beautiful trend line there with the earnings just sort of going up over time. Obviously the company had a bit of a rocky start here on inception, but after about sort of 2012 they've been making those positive changes where they've basically created a system that will continually grow, albeit it's utility, so they're growing at small amounts every year. Now, there are other utilities that have certainly been around much longer, with a much steadier earning potential. But at the moment, I think this is a utility that's at a good valuation. So we can sort of see here that the blended PE, or the sort of the approximate price to earnings ratio here is about 15 times, which is, as in my mind, is about a good point for entry for most companies under most circumstances. I think with utility stocks, they often trade at a premium. They often are very stable, and particularly as we start to think about heading into a recessionary and inflationary environment, I think this is also a really good option to pick up a utility trading at these valuations. Now, as you can see as well, the dividend yield is healthy, it's nice, and I can have a look at the performance to sort of see how that performance has been changing. And we can see the dividend growth over the last several years has been 10%, and we can pull this open here and just sort of get a sense for, they tend to bump up the dividend in the second quarter there, and they've been doing this consistently for several years by the looks of it. And we can see that here we've got a nice new dividend level as well. So it looks like another healthy bump. Now, when I look at utility stocks, I want to be able to see that these adjusted or operating earnings exceed that level of the dividend. So this is a little bit on the tight side for me. It's certainly tighter than I'd want to see. So there's an element of a risk here. I think the dividend is fully covered by the looks of the earnings versus the dividend level, and we'll have a look at the payout later. Now, I just want to quickly switch over to a couple of things. So I'm going to use fast graphs now to look at the future investment prospects. I'm going to switch this. This is an estimate here based on the 15 PE. Now we can see here there's a couple of elements. I'm going to switch this to using a normal multiple. So this is what the price to earnings has traded at over the last 5 years on average. So we can begin to see that at the moment it looks like it's quite a long way lower than that that 20 times PE. As I said, utilities often do trade at that premium level. But we can also see back here in 2021, it was trading at sort of 25 times. Now it's now it's down to about 15 times. Now, utilities are also very nice. You can buy them at lower valuations and ride them up as they become relatively overvalued again, and they often do go through these cycles. Now, I'll just switch back to historical as well, so we can sort of begin to get a sense of that. So if we say bought down here, as it began to hit the 15 times PE again, and then we held it up to maybe here, we can begin to see actually that we would have had a very healthy total return of about 63%, a total annualized return of about 13%, which is nice, and that's that sort of trading in and out that I talked about. Now, if you wanted to be a little bit more sort of aggressive, we could have entered perhaps at the same point, but began to get out at other points as well. So, for example, we could have entered there, and sort of exit as soon as it hits that sort of point. And again, you can pick up over a relatively short space of time a relatively high return, and a relatively good total annualized return there. What I want to do now, though, is I want to just have a look at what happens if the AQN begins to trade back up to this normalized PE ratio, so sort of the prices are increasing, so they're more back in line with that normal multiple, so prices are about 20 times the earnings, and I can click on this and I can see that we'd have a very healthy total return of about 75%, or an annualized return of about 30%. So in my mind that's fairly good. Now, obviously, stocks can go a lot lower. Anyone who's been in Stanley Walker, for example, there's been a number of stocks that have had rather cataclysmic collapses. Meta, for example, know that the prices can decrease quite a bit. Now in those particular cases, there the earnings also crashed, and that's part of what drives often that decrease in the stock prices. With utilities, it's much less likely that earnings will crash or disappear, basically, because of that steady nature of the utilities business. So I've got a lot more confidence here. Now, I want to draw your attention to a couple of other things. Now, fast graphs, one of the reasons I do love it is it begins to look at the analyst expectations and analyst estimates of earnings. Now, these are not to be taken as gospel. Obviously, analysts are as prone to overestimating as any one of us, but what they can do is they can allow us to get that picture for how the prices are, how those estimates are changing and what the likely future returns are. So as we can see here, we've got some fairly good estimates. There seems to be quite a lot of stability. They don't seem to change over time. That's what I like to see. Better would be sort of revisions upwards, where with time they're getting a better handle, that the earnings are going to be higher than they thought before. But ideally, with most utility stocks, we expect to see this, relatively stable estimates for the earnings that don't change too much. Now, obviously, as I said, take it with a grain of salt, but how accurate are these analysts? Well, again, one of the reasons I love fast graphs is it has an answer to that question, which is probably useful because the analyst expectations are a big driver of that predicted forecast return for the investor. Now we can see here, most of the time, looking at 1 year, analysts beat the estimates sort of roughly 1/3 of the time. They hit the estimates about 55% of the time. They only miss it a fraction of times. Looking out ahead 2 years, again, it's not quite as good. They're missing it sort of 1 time out of 7. But the rest of the time doing a pretty good job. Now this is with a 10% margin of error over 1 year or 20% margin of error over 2 years. So obviously looking further out into the future, we're giving the analysts a little bit more leeway there with making inaccurate forecasts. So I think this is a good stock to pick up. It's one that I've added to our own portfolio. It's got a nice dividend yield. The dividend yield's been increasing, as I said, by about 10% in recent years, and I would anticipate that to go up over time as well. Now, I'm just going to flick over to a couple of other useful tools here. So I also use Stock Rover, and we can sort of see that consistency here and the increases in the dividends with time. and that's quite nice. We can see here also in the returns chart, the grey line represents price returns. You can see the blue line there with the total returns also accounting for those dividends. This is a stock that has a reasonable return. Analyst expectations. So overall, they're not perfectly overall in favour of holding it and buying it. It's not one of their must buys. We can sort of see here that the sentiment's shifted slightly. So it looks like one of the holds shifted to a buy, perhaps, and a buy's shifted to a strong buy. So certainly, overall they're quite bullish about the stock. We can begin to scroll down, and we can begin to get a sense for how they are performing. Profitability, the metrics generally look good. The ROIC, which is one that I often do look at, is a little bit lower than the industry average, which is a little bit disappointing. But as I said, one of the main things I'm looking at for with the stock is yield. And dividend growth rate, which again is looking relatively healthy and relatively good. One of the big questions is it overall healthy? Now, the current ratio isn't quite where I'd like it to be. And I will note, however, that the Morningstar health rating for the company is about a B, so indicating that it's relatively healthy. Now, we can also get a sense here if we compare it to the peers, so comparable firms as well. We can get a sense for some of the valuations, and we can get a sense here for the overall quality of AQN, sort of in the middle of the pack. And so we can get a fairly good sense here that it's a reasonable stock. There's an element of risk here, and I'm going to switch over to Finbox. Now, Finbox also has a financial health rating, which is fair. So again, it's not as high as I would like to see. So it's certainly not a stock with an incredibly high conviction level for me. Upside here is calculated a little bit here based on the number of financial models that Finbox is using. But we can also see that there's a reasonable upside here based on the analyst targets. Now, even the low analyst target gives us some upside. The consensus analyst target over the 10 analysts is providing us with a reasonable upside as well. And we can sort of see as well with the different financial models that Finbox is using, we have a sort of a reasonable 26% upside, which sort of correlates reasonably well with the fast graph expectations also. Now, just in terms of making comparisons, so again, looking at some of those peers, so pulling through a number of different companies here, we can begin to get a measure of some of the risk levels. As I said, there's an element of a risk here. So we're beginning to look at, say, quick ratio, for example. It's not looking as healthy or as well covered as I would like. If we look at the overall health for AQN, again, it's got reasonable metrics for, say, cash flow, reasonable metrics for growth. So there's as I said, there's an element of risk here that we do need to consider. It's not the most stable, steady company out there, but it is a utility stock. And I'm going to switch back to fast graphs here. It's a utility stock. It's one where I think we can buy now at a reasonable discount, with the expectation that over time the prices will head higher, delivering capital appreciation, and we do get paid a really nice dividend while we wait. Now, in terms of what the company does, it's also quite involved in renewable energy. It's got a heavy investment in Atlantic sustainability, which I've also covered on Seeking Alpha recently. So it's got quite a heavy focus also on that sustainability, sustainable power, renewable power generation, and therefore this is also something that's of interest to me. So look, in my mind, as I said, this is an investment. We can certainly hold this for a long time, just collecting that dividend check. That dividend's going to increase with time. So for me, this is filling a component in my portfolio, also looking at current income and income growth, so the dividend and growth investment style. But I'm also anticipating some capital appreciation here. As I said, companies can decrease quite considerably with price declines, but this is something we're less likely to see with utilities. And so I think buying at a 15 times level for the PE ratio is a reasonable buy here. So look, thank you very much for joining me. Do let me know what you think about the AQN stock, whether or not this is a buy for you, whether or not this is something that interests you, and whether or not there's anything else here that you think you might avoid or be careful or wary about.